So why is gold going up? Well, I think, first of all, central banks have a certain unease about buying any more treasuries, especially in the emerging markets. And so they're continuing to accumulate gold with their surplus income as a reserve diversifier. And then, of course, there's people who just say, I'm not sure the dollar is quite what it used to be. I'm not sure that, going back 5 years ago, I could say with certainty that the dollars I'm holding would be the same thing 6 months from now or a year from now. But with everything that's going on, people are saying, you don't know what's going to happen tomorrow. Maybe I need to diversify into something else. And I think that's helping gold as well. Silver, of course, is riding on the wave of gold, but it also has the benefit of robust demand from solar panel production and from the green energy transition. So we're seeing net investment flows into silver, into ETFs related to silver, and into silver mining equities.
I think inflation is reaccelerating. The Fed is forced to lower rates and allowing inflation to run hotter. That's going to reaccelerate inflation normally. And I think that that's going to be very positive for hard assets.
Global markets are undergoing a structural transition, and the signals are becoming increasingly clear with each passing month. Gold's steady rise is not simply a speculative rally, but a response to a world where central banks are diversifying away from U.S. Treasuries, inflation is re-accelerating, and faith in the dollar is quietly eroding. Silver, too, is riding alongside gold's momentum, powered not only by investment flows, but also by industrial demand from solar panels and the broader green energy buildout. The bigger picture, however, is about capital rotation. Money is beginning to seek opportunities outside the traditional U.S. markets, eyeing emerging economies, energy, and mining equities as future beneficiaries of this shift. Clive Thompson, a market analyst with a deep background in resource investing, and Tavi Costa, a macro strategist known for his work on hard assets and monetary cycles, highlight how inflationary pressures, fiscal dominance, and suppressed rates create a landscape where tangible assets will continue to attract capital. From energy companies trading at historic lows despite strong earnings, to gold miners whose valuations lag far behind spot prices, the opportunities for disciplined investors are compelling. What emerges from this conversation is a clear message. The next decade may mirror past cycles where neglected assets suddenly become the drivers of wealth creation. Those prepared to see beyond the noise and position early will likely capture the upside. If you found this analysis helpful, make sure to like this video, subscribe for more insights, and share your thoughts in the comments below.
I mean, we're in a funny world, inflation is reaccelerating. Everything you said is very inflationary, especially if you look at the hard asset space. Gold is obviously, at least in my view, is probably leading inflation data in a big way, maybe a year out. And so I suspect we're in a world where inflation needs to run hotter than expected. Scott Besson has said many times, we got to, grow our way out of this debt problem. That's just a code word for inflation. We're going to inflate our way out, and we're going to have to suppress rates. And so what is basically becoming a policy, unavoidably, is the devaluation of the dollar versus other fiat currencies. What I think people are missing here is that this dollar movement, we've seen one of the biggest declines of the DXY index since the 70s, specifically 1973. And the question is it the beginning of a big downward movement or an exhausted move? And I certainly think this is a long-term problem. And as we see that becoming more pronounced in markets, I believe that that's going to catalyze other ideas, such as emerging markets that no one is positioned for. That to me is one of the most asymmetric opportunities in markets right now. Energy as well. I think you said it well. Energy has been lagging everything. And so I happen to have a very constructive view on energy right now. I mean, if you like energy companies and you're not bullish right now, I'm not sure exactly what type of analysis you're running, because it's they're making money. These companies are certainly one of the cheapest levels we've seen in history. And I would suspect that that's also going to become a big part of the onshoring and AI story as well. I think inflation is reaccelerating. The Fed is forced to lower rates and allowing inflation to run hotter. That's going to reaccelerate inflation normally. And I think that that's going to be very positive for hard assets. We're in a world where, although we're comparing with the 1970s, the world back then was very different than now. We were not running, for instance, a very steep current account problem. So there was no deficit on the fiscal side, or not a severe deficit on the trade balance side. There was no debt problem. We have those three issues now, and those three issues eventually cause what is called fiscal dominance, which is essentially lowering rates to allow your government to pay down your debt. And you don't do that with a strong dollar. You have to devalue the dollar. And so that's where emerging markets come from. If you think about from an investment standpoint, the two largest risks of investing in emerging markets are higher yields and higher dollar. We may see the opposite of that in this next 5 to 10 years. And so I firmly believe that while a lot of folks are paying attention to the corruption and all the differences we have in emerging markets, those structural problems are not going to change. What's going to happen is the capital flows that are exhausted already into the U.S. markets is likely to start switching and coming into, especially Latin America, where I think it's going to be one of the biggest beneficiaries. The fact, if you look at most of these projections for gold prices, at the end of the day, when you value a gold company, you're looking at projections for gold. Majority of the projections for gold are still 2,500. Long term, that's not my view. I think we can see double that in the next 5 years.
2,500?
2,500 is where the projections are. I think we can see, why not 5,000 gold prices in 5 years from now? And
well, $3,600, 5,000 doesn't seem so crazy.
Well, I think if you look at valuations, majority of the mining companies are still trading like gold prices are at, like I said, maybe even at 1,500. Yeah. And so look at the cost curve of these companies. All-in sustaining costs in average is still sub 1,300 for most of these companies. And they're producing at $3,600 gold prices on the top line. And so these margins are insane. And look, it's wonderful. And then people are going to start seeing the cash flowing side of it. And that's when institutions start to really deploy capital. We haven't seen the M&A, the real M&A excitement yet. I mean, that's still coming. The juniors are still really cheap. And so, yeah, this is a world that is only getting started. And notice the behavior of some of the junior companies beginning to perform better, especially when gold prices are down. That means that the institutional capital is finding its way into some of the places that, again, accepting more risk. They're taking more risk and they're being okay with that because they think gold prices will be here at these levels for the long term. And so, look, this is very, you buy a mine today. When you go buy a car, for instance, you buy a new car. Next day that you bought that car, the value of that car is down, 30% or so? Normal, right? Everybody faces that issue. Today, you buy a mine, it's the opposite. You buy a mine at the price that is the valuation of these mines are still at $2,500, $2,200 gold prices. Yeah. The day you buy that, you got a huge uplift on your valuation just because gold prices are actually at $3,600. I mean, there's some outstanding companies. There's too many companies in the mining industry.
Sure.
95% of them should probably be worth zero. Okay. And the other 5% have high quality assets. Your job as an investor in this industry, if you're in this part of the Lassonde curve, the left side of the Lassonde curve, is to figure out which ones are those 5%. Now, I would say that 75, 80% of them are probably very easy to figure out that you shouldn't be investing. And then the other 10, 15% are probably a little more tricky, 20%. And so that's where your challenge really is. Those companies that you just mentioned, not that you mentioned any names, but that part of the industry that has high quality assets and exploration side are probably going to be beat up. And it's an end game for those companies most likely. So 3 years ago, we decided to start deploying capital into that 5% that we thought were the high quality assets. And, things are starting to turn in a huge way. Another aspect that I would go back to is an analog of the 1970s. The 60s was also a period where we didn't see a lot of discoveries. There's a lot of issues there. And in the 70s, we saw gold prices rise. Mining companies did very well. But the 70s, we didn't see a lot of discoveries. That's why we saw this kind of 10-year period of bull market in gold prices too. Now, subsequently, 1980s and 90s, so after the bull market, we saw so much money coming into this industry. Market peaked. And then we saw an age of discovery. Capital was still there. And so companies went chase new discoveries, and they found a bunch of new discoveries in the 80s and the 90s. So I think we're maybe a decade out or maybe 5 years out of another discovery phase. That's going to happen too. It's going to be a natural part of the process here. I think monetary policy has become fiscal policy. You have to lower rates to allow the government to pay its debt. And so it's going to be a very tricky game to allow rates to ever rise. And if you're in that environment, you're probably going to let inflation to continue to run hotter. And and liquidity will continue to come in, and market and money is going to find its way in things that I believe are neglected and cheap and that are starting to move. As far as the Fed, look, I think that there's a reason to believe that they may not lower rates this next meeting, and the main reason for that is Fed could take the political route, or it could just say that inflation is running hotter. We're seeing data that inflation is running hotter than prior months, and that could be justification to maybe not lower rates like the market is expecting now. 2026, as you asked me the question, I think we're going to, unavoidably lower rates in a big way. And that's going to be, I don't think silver prices would be here at $40 an ounce in that environment. So, I don't know, that's the long-term or, more medium-term, long-term view. Very, very short-term, we may see a little, I'm not trying to make a lot of money in these types of predictions, but I'm very open-minded to that. And I think that's how investors need to approach this. If we see a pullback caused by that, I'm going to be a buyer because I think that they're going to go back and lower rates.
And lower rates in the big ways. Is that bullish or bearish for markets? So I've heard the opinion that it could be both.
It depends. If they lower rates in an economy that is hot and inflation is right there, then it's a different story.
Yeah.
We're a little bit stagflationary right now. It's I think the jury is out on where labor markets are. The data is difficult to judge. There's maybe some issues with the data as Trump has pointed out, and maybe even more issues now with a new person coming in and readjusting the data. Do we believe in that or not? I mean, it's difficult. But at the end of the day, liquidity is coming in and inflation is coming back. You can see, I think copper is, had a huge pullback, looks extremely cheap. You have other commodities doing very well. Energy looks very cheap. I like people to remind people about the dynamic that is very usual of a commodity cycle.
Gold continues to push into record territory, reflecting a combination of lower interest rate expectations, central bank demand, and a broader loss of confidence in the U.S. dollar. With the Federal Reserve widely expected to cut rates at its September meeting, the debate is less about if and more about how much. This easing bias, alongside revisions that show the labor market was far weaker than initially reported, reinforces the argument for ongoing monetary accommodation. Meanwhile, global central banks are reducing exposure to U.S. Treasuries and redirecting reserves into gold as a safer, long-term diversifier. Silver is benefiting from this same momentum, but with an added industrial tailwind from solar and green energy technologies. Platinum appears better positioned than palladium, given structural shifts in vehicle production, while palladium faces declining demand as gasoline-powered car sales shrink. At the same time, broader economic data is adding layers of uncertainty. Significant revisions to employment figures show overstated job growth, and the credibility of official statistics is now under scrutiny. Inflation prints arriving today will be decisive for near-term rate expectations, but the underlying picture remains one of weakening trust in fiat stability and persistent demand for tangible assets. Let's get back to the interview.
So what's driving the gold price? Well, the gold price, it's at an all-time high, as we know, but there's nothing new about that. I've probably said it 100 times in the last few years. All-time high, all-time high, all-time high. Well, we've got the lower interest rates, which are in the short term helping the expectation that the Federal Reserve will lower interest rates on the 17th of September. That's virtually a dead cert now. I think the only question is, will they lower the rates by 0.25% or will they lower them by more? The consensus is still they'll lower them by 0.25%, but it depends on some other things, including today's inflation number. So why is gold going up? Well, I think, first of all, central banks have a certain unease about buying any more treasuries, and so they're continuing to accumulate gold with their surplus income as a reserve diversifier. And then, of course, there's people who just say, I'm not sure the dollar is quite what it used to be. I'm not sure that, going back 5 years ago, I could say with certainty that the dollars I'm holding would be the same thing 6 months from now or a year from now. But with everything that's going on, people are saying, you don't know what's going to happen tomorrow. Maybe I need to diversify into something else. And I think that's helping gold as well. Silver, of course, is riding on the wave of gold, but it also has the benefit of robust demand from solar panel production and from the green energy transition. So we're seeing net investment flows into silver, into ETFs related to silver and into silver mining equities. Platinum and palladium. Platinum has prices moved a little bit higher than palladium. Palladium probably will not do too much in the coming years. It's facing structural decline as the gasoline car sales shrink, and it's basically used as catalytic converters in gasoline cars. But that's palladium. But platinum, on the other hand, is more used in diesel cars and hybrid cars. So platinum is the sort of metal which there'll be more demand for it in the future. So the outlook generally is better for platinum. But we can generally say, let's have a look at, have I got platinum and palladium here? No, I haven't got that. I can't show you those prices. What else is going on? Oh yes, yesterday we had some bad news on the jobs front. We heard that from the Bureau of Labour Statistics that between April 2024 and March 2025, the US economy created 911,000 fewer jobs than originally reported. That's 76,000 fewer jobs per month, roughly, on average, than they reported. And it suggests that the labour market was, for most of last year, much weaker than we thought originally. So even if we get a good number on the jobs front now, it's going to be somewhat muted by the story of the past few years, which looks so overstated. Today, the ECB will announce whether it's going to cut interest rates. The view is that they will stay at where they are at 2.15%. Nothing expected there. Big news last night was the Apple event. For those who have Apple phones, they unveiled an iPhone 17, a line of phones there, including the iPhone 17 Pro Max, the iPhone Air, which is an ultra-thin phone, the Apple Watch Series 11 Ultra, and the AirPods 3, which have the feature that when someone speaks to you in a foreign language, it will translate in your ear into English. So a kind of Babel device that you stick in your ear. This is the earphones in this case, but you stick the Babel fish in your ear, or in this case the AirPod in your ear, someone speaks to you and you'll hear it in the language of your choice. Now today's news will be all about, or what's going to happen today will be all about the US Consumer Price Index, expected at 2:30 European time today. So the expectation is that we'll have inflation coming in, the headline inflation at 0.2% and the core inflation at 0.3%. But what happens if the number is different from 0.2, 0.3%? What happens if it's lower? Well, if it's lower, that means the inflation rate is lower than expected, and the market will say, my God, there's even a bigger certainty of a rate cut. I'm probably going to expect 0.5% rate cut on the 17th of September. But if the rate comes in higher than 0.2, 0.3%, then perhaps the market will pare back its expectations of a 0.5% cut to just a 0.25% cut. But there's a question which will be asked, whatever the number is, and that's a credibility question, because after the Bureau of Labour Statistics jobs revisions last month, Trump fired the head of the Bureau of Labour Statistics, saying that the numbers were wrong. So, of course, there's always going to be a question of trust in the numbers. How much can we trust the numbers? And of course, we've seen the big revision of BLS figures in labour terms for last month. So, yeah, well, if CPI surprises either in either direction, some people will inevitably ask whether the data is reflecting economic reality or whether that data is reflecting political pressure.
The global financial landscape is shifting in ways that few can afford to ignore. We are watching the erosion of confidence in traditional measures of stability, currencies, government data, and central bank assurances. At the same time, the rotation into hard assets is becoming more visible. Precious metals, especially gold and silver, are no longer viewed as speculative sidelines. They are becoming core reserves and investment strategies for institutions and individuals alike. This movement reflects a more profound realization. Inflationary forces are not temporary, fiscal imbalances cannot be ignored, and monetary policy is increasingly constrained by political necessity. What makes this moment so critical is how multiple themes are converging. On one side, you have central banks quietly diversifying into metals. On the other hand, structural demand from technology and energy transitions is fueling industrial use. Add to that the weakening credibility of official statistics and the growing likelihood of sustained monetary easing, and the backdrop becomes clear. Hard assets are not just rising, they're signaling a repricing of risk across the entire system. This is where investors must stay ahead of the curve. The rotation is underway. Those who position early, with clarity and patience, stand to benefit the most as the cycle unfolds. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.